Hello everyone. In this recording we are going to discuss decision-making process and all the information needed to make relevant decisions. All right, now obviously managers along with the cost accountants, the cost accountant team, they have a lot of decisions to make in regard to manufacturing, deciding which parts to buy, deciding which units to manufacture, deciding on the activity level of how many to manufacture, how many to carry at any given time. There are a lot of decisions that need to be made within the organization before this process even starts. We, as customers, we take things for granted. We walk through Publix, we walk through Walmart, we walk through Home Depot, we walk through Best Buy, we walk through these stores, we shop on Amazon, we shop online, wherever we shop, and we don't even think about all the decisions that had to have been made before the product was on the shelves for us to simply come in and buy it. It's quite amazing how long of a process it takes to decide the levels of products that are going to be sold and, of course, the types of products that are going to be sold. These decisions are made, like I said, behind the scenes beforehand, and a lot of time with cost accounting information, the decisions are made. As we've talked earlier, managers will use that 5-step decision-making process that we talked about way back in Chapter 1. Of course, the decision is based on both quantitative and qualitative analyses. Because we are dealing with an accounting class, we are going to concentrate on the quantitative analyses, but I need everyone to understand that both quantitative and qualitative analyses is taking place here. We just happen to be concentrating on the quantitative. All right, so one of the first important pieces of information before we get into the details of this chapter is deciding on which revenues and which costs are relevant. Most of you have heard this term before. When I say something is relevant, that means that there is a difference among alternatives. So as an example, if I am deciding on between two contracts, I'm going to compare contract 1 versus contract 2. Obviously, by me signing this contract, it's going to occur in the future. It's going to cover a future period, number 1. And the two contracts are going to be different. Maybe there are different revenue streams that are promised to us based on the contract. Maybe there are different costs involved between the two revenue streams. So the relevant costs and the relevant revenue are only those that are different. So that's the key word. They differ. They are different among the alternatives. If, as an example, there's a same, let me give you an example. We have a fixed cost, which is rent for a manufacturing plant. Regardless if we choose alternative 1 or alternative 2, we're going to pay that rent. Regardless if we make 0 items or 1,000,000 items on the assembly line, on that assembly line, we have to pay the same rent. The rent does not differ between our alternatives. So guess what? In this example, rent is not relevant. Therefore, you will not consider rent when you are analyzing these two decisions or these two alternatives side by side. Another thing we need to understand with the concept of relevant, past costs or historical costs. Those are costs that are already made. We can't change time. We can't turn back time and say, I wish I didn't make that cost. I didn't spend that money. It's in the past, and I'm sure some of you are thinking, yeah, I can think of some of those situations in my own personal life where you made an expense and you're thinking to yourself, oh, what a mistake that was. It seemed like a good idea at the time, but oh boy, that was a mistake. Whether you bought the wrong car or you bought the wrong stocks or bonds or you bought the wrong whatever the case may be. You can't get that back. Now, obviously, in the future, if we are able to recoup some and we sell it, the future selling revenue, that's relevant. But the fact that we spent the money in the past, that historical cost, that is called a sunk cost, S-U-N-K. It's sunk. Think of it as it's done, it's already made, it's sunk to the bottom of the ocean. There's no way you're getting that money back. So past costs or sunk costs are never relevant. So do not consider sunk costs when you are analyzing potential alternatives. As I said earlier, managers will look at both qualitative as well as quantitative information. As this is an accounting course, we're going to concentrate on the quantitative side, but there are qualitative factors involved here. Of course, it could be something as simple as quality of life for our employees, and maybe that's the tiebreaker. That quality of life that might be relevant or that might be there for one alternative, but not the other, not so much the other. It could be something like maybe one alternative is better for the environment versus the other. All right, so there are certain qualitative facts as well that we should consider. Okay, here is an example of how you can analyze two alternatives. So we have two situations. One alternative where we basically stay status quo and we don't do any reorganization internally, or alternative two, we want to do a reorganization. So regardless if we reorganize or not, the revenues are going to be the same. So you can see it's $6,250,000 in each column. Now, if we reorganize or don't, we still have direct materials to pay. But look at the manufacturing labor. If we don't reorganize, we're going to spend $640,000 in labor. But if we reorganize, our labor costs go down to $480,000. So you see on the right-hand side, what are we doing? We're only considering the relevant revenues and costs. So when the revenues are the same or the costs are the same, you see over here, what do we have? We have dashes, which represent, no, 0, 0. We're not going to consider it because they're exactly the same. They're irrelevant. So reorganization cost is the other one. Obviously, if we don't reorganize, we have no reorganization cost. But if we do reorganize, we will have $90,000 as our expectation of reorg costs. So when we reorganize, the relevant costs are $640,000. If we don't reorganize, if we do reorganize, the relevant costs are the $480,000 plus the $90,000 or $570,000. You can see there is a $70,000 difference, $70,000 more in costs if we don't reorganize. So simply looking at this, I know there are qualitative factors involved here that we haven't even considered. Obviously, there are future revenues and costs that might differ among the alternatives that we need to consider. But just looking at what's on our screen, you would most likely decide, if all other things being equal, you would decide to reorganize because the operating income, as you see, is $70,000 more if we reorganize. So hopefully I made this impression on you. Whenever you're doing any of these decisions, whenever you are making any of these decisions, the bottom line, the most important fact is we are going to concentrate on the relevant revenues and costs. And hopefully I drill that point home. The relevant costs and revenues are only those that differ among the alternatives. That's why here we only considered the ones that are different between the alternatives. Okay, sunk cost, as I said, they've already occurred in the past. They can't be changed. You can't turn back time and undo that transaction. Sunk costs are excluded. They cannot be changed. Okay, they are spent. Now, if we happen to make a sale in the future to get additional revenue, that's different. But the fact of the matter, the cost that has been spent in the past, the actual cost, is irrelevant. Okay, Some more vocabulary here before we move on. An incremental cost is the additional cost incurred when we do one more activity. We make one more product. We make 10 more products. We make 100 more products. That is the incremental cost. So it's the increment, the difference, if you will. The differential cost, on the other hand, is the difference between the total costs between the two alternatives. So going back a couple of slides, the differential cost, as you see here, down here, is $70,000. That's the difference. That's what we call the differential cost. The incremental revenue would be the additional revenue for one more activity. And the differential revenue is the difference in the total revenue between the two alternatives. In our simple example, the differential revenue was 0 because the revenue streams were exactly the same among our alternatives. Okay, but if there was a difference, that would be considered the differential revenue. Okay, you can see on the next slides, these are examples. And we're going to go through a lot of these decisions as we work through our homework for this chapter. So even though the PowerPoint is more top level, where I'm going to actually kind of discuss these types of decisions, but actually showing you with detailed numbers and number crunching and number analysis, quantitative analysis, I need you to listen, of course, to the homework explanations video, because that is going to where you're actually going to see firsthand working through the problems. So like I said, the PowerPoint is more top level, more macro level. Getting through the details and more micro level. Listen, please, especially with this chapter, the micro level, the homework explanation video. So you can see the slide numbers here listed and all these decisions that companies need to make. As you recall, before I started this presentation, I was saying that there were a lot of decisions that were made before we even saw the product on the shelf, and here we are innocently shopping, and we have no idea the amount of decisions that are made behind the scenes before the product was even there for us to pick up. We so innocently shop, and we don't realize quite often lots of decisions that need to be made. And the first bullet point you see is a one-time only special order. Sometimes a company will work with their manufacturer on a one-time special order, which comes with a special price. Maybe it comes with special costs. You know, that's something that the manufacturer would need to decide whether to accept that special order or not. Short-run pricing decisions. So should we temporarily decrease our price to our customers? Insourcing versus outsourcing. This is make or buy. So insourcing means we're going to make the product ourselves. Outsourcing means we're going to get another organization to manufacture our product. Those are make or buy decisions. Do we make it ourselves or do we buy it from someone else? And then, of course, we can see there are various other analyses we would do for insourcing versus outsourcing. If we outsource, as an example, slide 21. If we outsource, meaning we have another organization actually do the manufacturing for us, now all of a sudden we have an empty assembly line. So what do we do with that idle facility? That's just an example. Product mix decisions with capacity constraints. Example, I have an assembly line with certain machines to manufacture products, and say I manufacture 3 different products, product A, product B, and product C. But I only have so much time on the machine, meaning I can't make all that I want to of product A, product B, and product C. Somebody has to be held back because of the constraint. What is a constraint? Basically, a constraint is what we call a bottleneck, where we are limited in the number of, in my example, we're limited in the number of hours on the machine. So we have to decide, well, which one do you make more of? Do you make more of product A? Do you make more of product B? Or do you make more of product C? So the decisions on making our product, manufacturing our product when we have capacity constraints. And we will see that later on in this discussion. As we were saying, bottlenecks. A bottleneck. Think of a soda bottle. And I'm talking about the one where you've got the bottle, and then as you get up to the bottleneck, what happens? The bottleneck is a lot narrower than the actual bottle. So if you are drinking the soda, what's happening? The force of the soda is slowing down as it gets to the bottleneck. So only a certain amount of liquid can flow through into your mouth. If the soda bottle did not have a bottleneck, meaning that the bottle was the same circumference on the bottom of the bottle all the way through to the top, like a glass. You're drinking out of a glass, as an example. All right, this is an example. Obviously, the liquid flow is going to be a lot faster. So a lot of times in business, what I'm saying, and I'm trying to make you visualize it, but what I'm trying to say is in business, when we have an assembly line process, a lot of times we have a bottleneck. And I gave the example before. We only have a certain amount of minutes or hours on the machine. Right? Or we only have so much access to employees that are actually making the manufacturing, that are doing the manufacturing. So these are decisions that we need to make when we have a bottleneck. Customer profitability. Do we want to stay with customer A, B, and C? But customer C seems like it's losing, we're losing money on customer C, or we're not making as much. And maybe customer D wants to come along. Do we want to replace customer C with customer D? These are examples that we need to discuss. How about segment reporting or branches? Do we add different branches? Do we close certain branches? Right? Have you ever noticed, I wonder why Walgreens closed down that store on this particular corner by my house, or CVS, or Burger King, or whatever, whoever. You thinking to yourself, why did they close down? Well, they're making the decisions internally. They're not just waking up one morning and say, let's close the store in Coral Springs on this corner. No, they are making decisions both with quantitative and qualitative analyses behind the scenes. They are deciding whether to add branches or discontinue certain branches. Equipment replacement. And you all may have encountered something like this in your life. When is the right time to replace our car, as an example? And then you have to go through this decision-making process, both quantitative and qualitative. Now, a lot of you might be geared towards quantitative. You're going to think, okay, how much does it cost me to keep my old car? Maybe there's no more car payment. Maybe there's no more, there's not a lease payment. There's no more car payment. The car's in relatively good shape, so the mechanic bills are kind of quiet. But the car is getting kind of old. And maybe you want the new technology. Maybe you want the new safety equipment in the new car. These are both, what am I doing? I'm throwing quantitative analysis at you in the beginning, and now I'm throwing some qualitative analysis at you, right? New technologies, new safety equipment, all right? These are all qualitative factors versus no more car payment or very small mechanic bill. These are quantitative analyses. So certainly we would do the same if we have to decide when do we replace our equipment, our machinery, our equipment. Okay, so you can see lots of details here. Let's take a look at one-time only special orders. Here's the bottom line with special orders. If we can add to the contribution margin, quantitatively, we would accept it. Does the special order generate additional operating income? If yes, we accept. If no, we reject. Bottom line. And if you think about our contribution format income statement, let me go through it with you one more time, which we learned earlier in the semester. Remember, it's revenues less variable costs will give you contribution margin. Contribution margin less fixed costs equals operating income. So if fixed costs remain the same regardless of activity, if you think about the formula I just gave you, that means whatever happens to contribution margin is also going to happen to operating income. So if we can concentrate on the contribution margin, if a special order will add to the contribution margin, most likely it's going to also add to the operating income. Because the only difference between the contribution margin and the operating income are fixed costs. So if fixed costs remain the same, all right, we are going to go ahead and analyze the special order that way. Okay, so here is an example. We can see on the left-hand side with this Excel spreadsheet, without the special order, we are selling 30,000 units at $20, which is our sales price. So 30,000 over here, 30,000 units times $20 per unit. That gives us $600,000. Our manufacturing variable cost is $750 per unit. $750 times 30,000 is your $225. Anyway, you go down the line. Now, if we had an opportunity to get a special order of 5,000 units, but our customer doesn't want to pay $20 per unit. Instead, they want to pay $11 per unit. So we would make not only the $600,000, an additional $11 per unit times an additional 5,000 units, we'd make an additional $55,000. So we'd go from $600,000 to $655,000. Our manufacturing is still $750 per unit. All right, the marketing is exactly the same because in this example, we were told there won't be any additional marketing costs. Okay, so that's going to be the same. All right, so what's happening? Our contribution margin is going from 225 to 242. The fixed costs remain the same, regardless if we accept the special order or not. All right, so that means the difference or the relevant costs, all right, this last column are the relevant costs, the difference between alternative 1, which is don't accept the special order, column D, and column F, accept the special order. All right, so we have a $17,500 difference to contribution margin, which is the same as the difference to operating income. Looking at this quantitatively only, without looking at any qualitative factors, we would say yes to accepting this special order. Okay, just a couple of points here. This is very important. We can't assume anything, all right? Here's a general assumption that we should avoid. All variable costs are relevant and all fixed costs are irrelevant. Well, let me go back one slide. Marketing was a variable cost. Was it relevant here? The answer is no. Why? Because we were told in this example, if we accept the special order, we don't have to add any more of marketing costs. So even though marketing is a variable cost, it's irrelevant. And yes, in this example, both fixed costs are also irrelevant, but there might be times where we have to add a fixed cost if we accept the special order. So don't make the assumption, even though it's correct most of the time, don't make the assumption that all variable are relevant and all fixed are irrelevant. All right? So this is so very important. The author is going on here by saying the other thing you want to stay away from is unit fixed cost data. This is so dangerous. So as an example, with the manufacturing cost, we know it's $135,000 is the fixed cost. When you divide it over 30,000 units, the per unit is $450. But now when we add the 35,000 units, your fixed cost per unit is actually going to decrease. So the fixed cost per unit is actually something that should not be used when we are doing analyses. We really need to look at the totals. That's what really counts here. The per unit, that's going to flip-flop around depending on how many units we are making. All right, we can make 0 units or 1,000,000 units. As long as we're within the relevant range, this fixed cost per unit is going to change. So we really should avoid using fixed unit costs. Be very careful with that. Next analysis, short-run pricing decisions. So that's basically what a special order is. The example we just had was, hey, this one-time customer, maybe it's not a one-time customer, but this customer at this one time, they want to make a special order, but they don't want to pay $20. They want to pay $11. This is a short-term pricing decision we need to make. Should we accept it or not? There are dangers in accepting it, of course. We have to decide quantitatively and qualitatively, but certainly this is something that we need to decide. Is this short-term price, this one-time price, is it an acceptable price? All right, and like I said, quantitatively, we said yes, it was. Insourcing versus outsourcing. And this is another way of saying, do we make it ourselves or do we buy it outright? All right, outsourcing is when we purchase goods and services from an outside vendor. Insourcing means we'll produce the good ourselves within the organization using our own labor, our own materials, our own overhead. This is also known as a make or buy decision. And now I bring up another vocabulary word which is important to us, and that is called an opportunity cost. Some of you may have heard this already, but I'll mention it here again if you haven't heard this with another class or if you forgot. An opportunity cost is basically the benefit given up by choosing one alternative over another. You cannot really it's really hard to put a dollar amount to an opportunity cost. A lot of times opportunity costs are qualitative in nature. All right, but the opportunity cost, once again, is the benefit given up by choosing one alternative over another. Okay, so when we outsource, all of a sudden we have an empty facility. So if we outsource, we also might consider, all right, so in the same decision, if we outsource, yes, we have the costs to outsource it, but now we can utilize our facilities for something else. And if we can utilize our facilities to make a profit on something else, we need to consider that quantitatively within the decision-making process. So this is something we need to understand. Outsourcing decisions, obviously, they might have a long-run horizon. We might outsource for the next and have to sign a contract for 5 years or 10 years. So certainly this is a strategic decision that we need to make because it's not going to affect just the current period. All right, if we outsource internationally, which happens a lot, how many times have you picked up a product here in the United States and it says made in China? Right, so international, that's because of international outsourcing. Right, you're going to a different country. All right, you have to evaluate not only the other country's labor costs, but also transportation costs, exchange rate risks, the quality of the product made outside of your domain, the reliability of this international outsourcing company, how efficient they are. So certainly international outsourcing, there's a lot of decisions, both quantitative as well as qualitative. Obviously, if the quality of the product isn't as good, now all of a sudden we have customer service issues. We have perception issues. There's a lot of decisions that need to be made. And it just blows me away. And I know I keep saying this, but a lot of us, we shop. We don't even realize all these decisions that were made beforehand, before the product is in our hands. Okay, earlier we were discussing looking at the relevant differences, the relevant revenues and costs, which are the difference between alternative 1 versus alternative 2. Another way a company can look at this is called the total alternatives approach. This means that the manager will focus on all future costs and revenues for all products. Okay, so this is something that could be used as well. Okay. Product mix decisions. As I said, we have a capacity constraint. We only have a certain amount of time. This is an example. We only have a certain amount of time on a machine, which is the constraint. So which products do we make? I know we have 3, 4, 10, 12 100, a million products we make, which ones do we concentrate on? So we need to choose the right product mix that will not only give us the highest operating profit, which is what we would do when we do quantitative analysis, but also we need to keep our customers happy. We need to keep up with customer demand as well. Okay, simple example. Let's say we make two products, product A and product B. We could see product A has a selling price of 10, variable cost of 6, therefore your contribution margin per unit is 4. All right, which works out to 40%. 4 divided by 10. Product B, selling price is $30 minus a $15 variable cost will give us a $15 contribution margin. 15 divided by 30 is 50%. All other things being equal, if you only were able, you had such a constraint on the manufacturing assembly line, and we were told you can only make one product, product A or product B, which one would you choose? Looking at the contribution margin, 4 for product A, 15 for B. Product A contribution margin percent, 40% versus B, 50%. All other things being equal, you would probably choose product B, saying the contribution margin percentage is higher. The contribution margin per unit is higher. Not so fast. What is the constraint? As I said to you, the constraint is time on the machine. Well, product A, it takes us 0.5 or half hour, 30 minutes to make one product. All right. So if the contribution margin is $4 a unit, how many can I make in an hour? I can make 2 in an hour, can't I? So 4 times 2, my contribution margin per machine hour is now 8. It's the $4 per unit, and we can make 2 an hour. 8. But product B, yes, the contribution margin per unit is 15, but it takes 3 hours to make 1 unit. So what is my contribution margin per hour? It's 15 divided by 3, or 5. Now which one do we choose? A. So when we are making decisions based on the constraint, we have to figure out what is the contribution margin per the constraint. In this case, the constraint is hours on the machine. All right? Be very, very careful. All right? And a lot of companies, a lot of organizations, they're just going to look at this. Contribution margin per unit. A is 4, B is 15. Heck, I'm making a whole bunch of Bs. Well, guess what? You would have hurt your bottom line if you stopped there. And we had this constraint. Be very, very careful. Brings me into the next point, the bottleneck. I explained the whole idea of the soda bottle before, so you get a visual of what the bottleneck is. So, you know, the actual machine itself, in the example, the limit of the hours on the machine, that would be an example of a bottleneck. Maybe the bottleneck is our suppliers, where we get our raw materials from. Maybe they are constrained in how many materials we can buy from them and get from them. These are decisions that need to be made whenever we have these constraints, whether it's in our own domain, our own assembly line. We're limited in the amount of employees. Maybe there's a shortage of special, employees that have the specialization in making a certain product, or whatever the case may be. These are the constraints that we would need to analyze. Okay, so when we do have a bottleneck, we need to first of all recognize the bottleneck, all right, and then of course recognize the bottleneck operations, all right, to determine the contribution margin of the entire system, identify where the bottlenecks are, and then of course figure out what is the contribution margin per the bottleneck, if you will. This basically helps us in making decisions. Customer profitability. We might have multiple different customers. Sometimes it's not as simple as all customers pay the same price, and no. Customers work out their own contracts. I'm talking about, once again, I'm the manufacturer and I'm selling to my retailers, okay, or wholesalers, right? So if I'm the manufacturer, I'm selling to wholesalers. Each wholesaler is going to have a different contract. Certain wholesalers we make more profit on than others. So once again, should we keep adding different customers that have higher profitability? Should we drop customers that might be dragging down our operating income? Quantitatively, this is what we're going to go through in making decisions like that. Here's an example where we have 4 customers. You can see we have Vogel, Brenner, Whisk, 3 customers. When you actually look at these customers, a lot of times you'll look at the operating income saying Vogel adds $9,000 to our operating income. Brenner, $16,000. Whisk, negative $32,000. I wonder if I should get rid of Whisk. Well, you have to go beyond just looking at this operating income, which is negative $32,000, because there are certain costs in here that are not relevant to the decision. Example, depreciation. You see this depreciation of $9,000 in Whisk column? That $9,000 of depreciation is going to continue whether we drop Whisk or not. Remember, we bought the fixed asset already. It's a sunk cost. We will have the depreciation expense whether Whisk continues as a customer or not. So the $9,000 is irrelevant. Now the revenue is relevant. The cost of goods sold is relevant. The labor is most likely relevant. All right, because I hate to say it, but we'd have to let people go if we got rid of this customer. The depreciation is irrelevant. The rent is probably irrelevant too. The rent is on our assembly line. And all we would do is probably take the $14,000 that we allocated to Whisk and allocate it to Vogel and Brenner, some additional rents. So rent could be irrelevant. The depreciation could be relevant. All right, marketing support. That's probably relevant. Sales order and delivery processing, probably relevant. General administration. That $16,000 is going to stay. So that is irrelevant. The $8,000 allocated corporate office cost, that stays. I just analyzed 9 plus 14, that's 23. 23 plus 16 plus 8. It's what is that? 23 plus, that's $47,000 that I just said to you is probably going to stay as costs. They are irrelevant. So did Whisk really lose negative $32,000? No, they didn't. Whisk is actually profitable. All right, considering these 4 costs that I said were irrelevant to the decision. So don't just look at the bottom line and say, oh, the customer is losing us money, we're going to get rid of Whisk. No. If you did that and you got rid of Whisk, you just lost money. All right, so be very careful with these costs that are irrelevant. They should not be considered when you're making these decisions. Okay? So be mindful of that. All right, so and that's basically what we were talking about. We need to be careful of looking at the cost before we decide to add or drop a customer. All right, same thing with adding or dropping a branch. Same thought process. You have to go through each and every revenue and cost to see which ones are relevant. The ones that are irrelevant, meaning it's going to stay the same whether we drop or add. All right, you don't consider them in the decision. Very, very important. Items that are never relevant. The cost of fixed assets we bought in the past, accumulated depreciation, book value of existing equipment, and depreciation itself. Now, potential gains or losses in the future on selling equipment, that's something that we would, over here, some items of cost that may be relevant. Current disposal value of an old machine. The cost of a new machine, this would be an outflow of cash. Current disposal would be an inflow of cash. That's something that we might consider as relevant. I probably would, all other things being equal, as I like to say. All right, but anything that happened in the past, right? This is something that is irrelevant to the decision. It's a sunk cost. And then, of course, these slides are basically talking about we could do all the quantitative analysis we want in the world, but we also have to consider qualitative. Managers will consider how the company will judge his or her performance after the decision is implemented. Many managers consider it unethical to take actions that make their own performance look good when these actions are not in the best interest of the firm. So you can make a short-term decision to help your own bonus and your own paycheck for a particular year, but let's say 3 years later, it's realized across the board what a bad decision it was that you keep making. Ultimately, you're going to lose your job. So think about it. Did it help you to get that short-term bonus in year 1, maybe year 2, maybe year 3, but in year 4 or 5, you're actually going to get fired for it? Probably not the best idea. So obviously, you need to look at the good of the company as a whole. All right. So a lot of times, quantitative decisions and qualitative will help us. All right. So certainly, we need to look at both quantitative and qualitative.